I'll prepare some good questions for you, Augustine. Okay.
Well, good afternoon. It's for me a real pleasure to be here again at the MAS. I'm very grateful to Ravi Menon for hosting us here and for his tremendous support he has given us through all this time, in particular hosting uh, our our innovation center here, being a partner with us in that respect. And I would say more than that, by constantly inspiring us about technology. Ravi is a real leader in this field, and I have to say that it has been extremely productive, our interaction. So let me say that it's also great to give this speech here in Singapore, because also Singapore uh, is now very well known as being a true hotbed of financial technology and innovation in Asia. So, as the Singapore FinTech Festival demonstrates year after year, innovation in money and payments is moving at a very rapid pace, and often with the goal to rethink how do we use money. Certainly, the MAS has made a substantial contribution in this respect. More generally, central banks have a duty to keep up with technological change and changes in users' demands to ensure that central bank money is made available in a way that is relevant for the digital economy. This is part of central bank's mandate to serve the public. Today, I would like to make the point that to reap the greatest benefits of innovation in money and payments, we must think big. We need to have a vision for the future monetary system and for the role of central banks in driving innovation that meets evolving needs. This is not an easy feat, thanks to the nature of innovation itself, which is rarely linear and often unpredictable. A great example of that is the evolution of smartphones. When Steve Jobs strode on the stage to unveil the first iPhone in 2007, it was described as a laptop in the form of a phone. Its connection to the internet did not receive much attention. And by many accounts, Apple's leaders were reluctant to let outsiders to develop applications to use on it. It's hard to believe that this was only 16 years ago. Nobody could have predicted how fundamentally the smartphone has changed the way we work, communicate, and interact. All these changes happened not because smartphones imitated computers, but because they let others use their creativity to develop new products and services through apps. The smartphone offers a couple of lessons about innovation. First, the innovation First, for innovation to flourish, it requires a stable and safe infrastructure that unleashes the private sector's creativity and ingenuity. And second, the various components on a platform must be able to work together seamlessly, just like when I use my phone to take a picture and share it on social media. This is closely related to the notion of composability, which I will develop further. But in looking at these examples, we must also be aware of what not to do. Dominant technological platforms can often exploit networks effects to stifle competition and lock customers inside walled gardens. This is one aspect in which the role of central banks in innovation diverges from the private sector. As accountable public institutions, central banks strive to serve the public interest rather than private profits. With these points in mind, let me elaborate on how we can translate these lessons into the world of financial innovation, especially from a central bank perspective. Even though it is inherently difficult to predict what form of innovation will take, we must make sure that we have the right infrastructure in place to promote it in a sound and open way. I put forward the case of that central banks, as the guardians of trust in money, are uniquely positioned to lay the foundations for such next generation infrastructure. Around the world, central banks are exploring how to give money new capabilities. The B.I.S. is supporting much of this work as it incubates projects and catalyzes new ideas in the world of central banking. This includes work on central bank digital currencies at both wholesale and retail levels, as well as fast payment systems and their interlinkages across borders. We're also experimenting with the tokenization of different assets, including tokenized deposits. But to fully realize the transformative potential of these new financial technologies, we need some way to bring them all together. In this regard, there is a great promise in developing the idea of a unified ledger with a common programming environment. A unified ledger is a digital infrastructure with the potential to combine the monetary system with other registries of real and financial claims. It would need to be a public private partnership with clear division of roles and where the central bank tasked with underpinning the trust in money. Like smartphone platforms, a unified ledger allows various components to work seamlessly together. But unlike them, it is enabled by open architecture that promotes financial inclusion and greater competition. Such a ledger allows for the use of smart contracts and composability. A smart contract is a computer program that executes conditional if then and while commands. Composability means that many smart contracts covering multiple transactions and situations can be bundled together like a money Lego. With these new functionalities, any sequence of transactions in programmable money can be automated and seamlessly integrated. This reduces the need for manual interventions that delay transactions and reduces dependency on intermediaries, and also allows for simultaneous and near instant payments and settlement. Greater interoperability and automated transfers could ultimately benefit consumers through more convenient and cheaper products that are better tailored to their needs, thereby enhancing financial inclusion. These foreseeable gains may just be the tip of the iceberg of additional transformations. Think about how the smartphone displays digital cameras. It was not because it takes better pictures, but because it's easier to share these pictures with friends through the same device. Importantly, programmability and composability do not require decentralized or permissionless platforms. All the potential benefits I just outlined can be achieved in permission platforms with various degrees of centralization. What really brings the benefits of these projects together is the use of money as a means of payments and settlement. As a provider of the ultimate settlement asset in the economy, the central bank therefore has an important role to play in the governance of a unified ledger. But it would do so in partnership with other public agencies as well as with private sector participants. In designing these new infrastructures, there has to be clear thinking on the respective roles of the central bank and the private sector. The central bank stands at the core of the monetary system. It continues to issue central bank money as the economy unit of account and ensures the ultimate finality of payments through settlement on its balance sheet. However, the consumer facing activities are based taken on by the private sector. So a guiding principle for the unified ledger is to preserve this partnership between the central bank and the private sector. The aim is to tap into private sector creativity and ingenuity to develop new products and services rather as the smartphone makers decided to open their platforms to outside developers. Without the almost 2 million apps that exist today, the smartphone ecosystem would be that much poorer. Trust in the central bank and the regulatory and supervisory infrastructure preserves an essential feature on the monetary system, the singleness of money. Singleness refers to the fact that private money is issued by different banks and central bank's money all trade at par. One Singaporean dollar deposited in my bank is worth one Singaporean dollar in another bank, and I can convert my deposits into the same amount of cash at an ATM. Viewed through this lens, it is clear that CBDCs and tokenized deposits do not represent new types of money. Instead, they replicate existing forms of money in technologically superior way. CBDCs, for example, would play the role that central bank money plays in today's system. Tokenized deposits will play the role of commercial bank money. What makes central bank money and commercial bank money indistinguishable today is a complex and well-developed network of institutional arrangements, including regulation, supervision, deposit insurance, and settlement on the central bank's books. The same should be true of CBDC and tokenized deposits. But how are we to take full advantage of these technologically superior forms of money? This is where the unified ledger comes in. CBDCs and tokenized deposits would appear in separate partitions of the unified ledger. Because they share a common ledger, they can be brought together and used in an efficient way through smart contracts. This would facilitate inclusion and lower transaction costs. Other partitions of the ledger could be used for other assets. The novel functionalities arising from this design can enable money to work more efficiently. It takes me to my next point. When combined with programmability and composability, the additional functionality could open a whole new range of services that impact our daily lives. One example is by enabling micropayments that are currently not economical, such as tips to the providers of social media content or direct payments between Internet of Things devices. Tokenized deposits and CBDCs could also open the door for more efficient payment arrangements in business settings or for larger purchases. For example, the B.I.S. Innovation Hub Singapore Center plans to experiment with embedding policy and regulatory measures in smart contracts with the view of how to automating compliance and increasing transparency. Compliance costs are large, but by using tokenized deposits and smart contracts, costs would fall, making payments more efficient. This would facilitate inclusion. Another example would be the process of escrow for buying a house. Escrow accounts secure the funds provided by the buyer until the conditions of a real estate contract are fulfilled. As escrow accounts are usually handled by a third party, the escrow process involves the transfer of funds across different accounts, often at different banks. Using a smart contract, the escrow process could be automated by locking the respective funds in the buyer's account. Once the escrow process is concluded, the smart contract transfers the money to the seller automatically, and instant settlement is achieved via digital central bank money. By relying on the same institutional structure and using the same trusted settlement asset as in today's system, the singleness of money is preserved. The full benefits of this revamped escrow process arise from having commercial bank deposits and central bank money in the same programmable form on an integrated platform, a unified ledger. Thinking even further ahead, we could envisage both assets and multiple regulated entities, commercial banks, payment services providers, assets registries, etc., in coordination with the central bank on the unified ledger. The idea is to put complementary things, central bank money, commercial bank money, digital assets, in the same place so that they can interact in efficient ways, like apps on a smartphone. This tokenization could make buying, selling, and transferring assets faster, cheaper, and more transparent. Indeed, it could even make delayed settlements of different assets like bonds, stocks, and foreign exchange a thing of the past. The level of certainty in financial markets would, needless to say, increase markedly. There may be broader economic advantages. As data are recorded on the unified ledger, we can create common and trusted knowledge in a secure and privacy protecting way. This can open the door for contracts that are not feasible today and which can help individuals and firms to better manage risks. Of course, there are alternative visions of what the future monetary system and digital money could look like. For example, many crypto proponents argue that stablecoins should be in the future of money. But what this view forgets is that what sustains fiat money is not the application of novel technologies, but all the institutional arrangements and social conventions behind it. And it is precisely these arrangements and conventions that make money reliable for the public. Indeed, the past year's events have cast serious doubts on the ability of stablecoins to function as money. Stablecoins must import their credibility from sovereign fiat currencies. They do not benefit from the regulatory requirements and protections applying to bank deposits. They do not settle in central bank money or enjoy lender of last resort support. Accordingly, they cannot guarantee the singleness of money. Admittedly, most stablecoins trade closer to par when all is well, but things are not always well, and when that happens, exchange rates across payment instruments creep in and the singleness of money is broken. By departing from this core principle, we lose an important part of the soul of money. Tokenized deposit, in contrast, embody the key aspects of our current system, whereby central bank money and commercial bank money are indistinguishable and come with certain assurances. However, there is an important lesson to be taken from stablecoins from a public perspective. Stablecoins arose in part because some of the technical capabilities they provide cannot currently be met by existing form of money. It is incumbent upon central banks to make sure they contribute to developing an infrastructure that meets these demands. If central banks do not innovate, others will step in. In the meantime, we must ensure that stablecoins do not harm investors and consumers or, or contribute to a fragmentation of the monetary system that undermines the singleness of money. So stablecoins could, in principle, or should in principle exist, but on a very tight regulatory framework while we develop the uh, other options. Let me conclude. Central banks must embrace innovation. They have a powerful and important mandate to provide safe and stable money and in the most efficient and useful way for society. To embrace its evolution and potential, they should build on the strong foundations that exist, but not to be limited by them. Facilitating the existence of CBDC and tokenized deposits would provide the technological representation of money that further innovation needs. Bringing them into a unified ledger would have a catalytic effect on further innovation conducted by the private sector. The good news is that central banks around the world are actively working towards a monetary system that embeds the best of new technology in the solid foundations of the current two-tier structure. The goal is to build a future monetary system that is adaptable and enables innovation by the private sector in a safe and sound way, in whichever form it may come. Thank you very much.
Having me here today. I'm big tech and crypto, and I'm going to start with crypto as well before getting to big tech. A few words from on some recent work that the U.S. Treasury with the financial regulators in the U.S. have been working on. We wrote a number of reports last year responding to the president's executive order on fostering responsible development of digital assets. And the report made a few distinctions that I think are important. One, unbacked crypto assets, which I think Christian called tokens, which we believe were mainly used for speculative trading. Two, stable coins, which can be as a settlement asset in crypto markets and could be used more widely for payments. Three, a central bank digital currency, which could be a new type of central bank liability. And then fourth, the underlying technology, which may support innovation in clearing and settlement of traditional assets as well as digital assets. So with regard to the technology, Treasury has been supportive of exploring the potential benefits for the future of money and payments. New products could include well-regulated, securely backed stable coins, some type of tokenized deposits, and central bank digital currencies. And these could enable instant payments, 24/7, atomic settlement, and programmable money. Potential applications include domestic and cross-border payments and settlement of tokenized securities. In contrast, the unbacked crypto products, the tokens, we found to be too speculative, too volatile to be used for payments. In the reports, we recommended that existing investor and consumer protection laws should be enforced rigorously to crack down on the fraud, abuses, and the conflicts, to protect consumers and to prevent financial stability risks from emerging. And where gaps in existing authorities exist, and there are gaps, we urged Congress to pass legislation. That was our take on crypto. I think it's actually quite consistent. We did not bring up the issue of proper measurement, but that is a good path forward. So this panel, though, is focused on big tech and crypto, and it's an intersection of a topic we've been talking about all day. These reports didn't specifically address the connection to big tech, but since we think the future value of crypto is for payments and not for speculative trading, the natural connection I'm going to make today is to big tech is through payments and stable coins. So in the US, unlike some other countries, big tech firms are not a dominant presence in payment systems. Apple Pay, Google Pay, for example, are among a large number of retail payment providers. They operate generally with partnerships with banks or offered directly through non-bank financial subs. Ultimately, the transactions are settled on interbank payment rails. Now, some of these firms, and including some big tech firms, appear to be exploring stablecoins, and we expect that, and where payments could occur outside the traditional payment rails. And so this potential combination raises a number of financial risks, as well as other policy considerations. So we analyzed the risks of stablecoins that could be used for payments in a President's Working Group report in 2021. We cited concerns about run risk, investor runs, and then redemption and operations risks. And that led us to some recommendations to establish a prudential regulatory framework for stablecoins to ensure convertibility, as well as oversight of custodial wallets to ensure segregation of accounts. Another risk we cited, but is often less discussed, is related to their possible rapid scaling up because of network effects. And it's this potential combination of stablecoin with big tech, with its large existing user base, that makes this risk actually quite tangible and palpable. So we've discussed a few of the economic forces of payment systems and big tech today. Just to repeat a bit, first, both can exhibit network effects. That occurs when the value of the platform to an individual user increases when others also use the platform. So a social media platform is more useful to its users when the larger that the network is. And a closely related concept is strategic complements. And a strategic complement occurs when the actions of one individual depend positively on the action of another. So I'm more likely to send you a message on a social media platform. If you send me a message on the same platform, I'm more likely to use a stable coin if you've paid me with that stable coin. And we can see strategic complementarities across products. And that would be like the payment platform and the social media platform. If you pay me with a stable coin on an e-commerce platform, I'm more likely to buy something with a stable coin on that e-commerce platform. And in addition, we see that the user data that you glean from one line of business can support growth in another line. So as user activities grow, so does the amount of useful data that you can collect. So these factors, that's just running through them very quickly though, can lead to large existing big tech user bases for social media or e-commerce, could allow them to scale very rapidly in directly offering money instruments. This could lead to reduced number of retail payment providers and reduced competition. In addition, the large scale big tech and stable coins, where stable coins are not fungible with other kinds of money, could lead to kind of pocket economies, closed economies emerging, undermining the singleness of currency, and thereby also threatening monetary policy transmission. So that's just a number of things that we can start with and highlight. These obviously raise a number of policy issues, financial stability, competition. I just want to close by mentioning one, the concentration of economic power, which has come up in the US. In the US, there is a separation. There's not a doctrine. There's a separation of banking and commerce. It's been long held. It's existed since the country's founding, and it has limited to date the services that big tech platforms provide in financial services. It was motivated by a number of things and is still pretty held. Could be the risks of commerce spill into the banking sector. It could be that the banking would subsidize their affiliates, the commercial affiliates, and penalize competitors or give an unfair advantage to their affiliates. But there's also this general aversion to the kind of concentration of economic power that could result if banking and commerce were combined. That concern is still present. It might be a little different now. It could turn out to be that the e-commerce would subsidize a bank because of the data, and the bank itself is the less viable entity. But still, it is the same issue. And Mike Sue mentioned earlier today, in 2015, perhaps Walmart wanted to open a bank, and there was a lot of concern about that in the country. And ultimately, Walmart stepped back, has a partnership with the bank to provide some financial services, but in the end did not purchase a bank. So I'll stop there. Thank you.
Thank you, Nelly, for laying out those important issues in the